This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of the show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Investor Connect is a 501c3 nonprofit dedicated to the education of investors and startups for fundraising. Please consider donating $100 to the program to help others in their investor and entrepreneur journey. You can find the donate button on the investorconnect.org website. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Matt McGraw, co-founder and managing partner at Anthropocene Ventures. Anthropocene Ventures is a global early-stage VC firm investing in founders that leverage exponential technologies and hard science to make humanity more resilient. Matt, thank you for joining us.
Hey, thanks for having me.
Great. So tell us more about your background before investing in early-stage companies. How did you get here?
Yeah, well, I'm new to the VC game. I grew my horns as a VC just about 2 years ago. I'm an operator and founder. I had a company called Rocket Science that I founded in 2000 that helped quickly scaling startup scale. So for 15 years, 20 really with my first job in tech in the 90s, I've been applying technology to help businesses scale rapidly, innovate and commercialize their own products, and kind of at the intersection of venture and startups. We also worked a bunch in corporate and innovation. So I've got this like broad background, both in consulting and making that consulting work into a reality. So services, product and design, DevOps, hardware, networking, BPO governance, all of this we made happen for kind of the bigger startups that you've heard of, the Airbnbs, the Ubers, Postmates, Twitters, Facebooks. And then I retired. I got sick of the tech industry really in 2015, kind of all the reductive business models that were happening in software. Didn't think it was a net good for the world either. So I sold everything, retired. I have a big family, 6 kids, and thought I was going to ride off into the sunset, but apparently I'm pretty bad at that. Because about 2 years later, I founded 2 blockchain companies. I think I see that tech as a really wonderful new governance model that at its best matches my thinking and thoughts on how the political economy should operate and new services and platforms. So in that round of my founding and operating experience, I did software, governance, finance, regulation. It was global. And because of this community, I kind of got into the global early stage crypto projects. But then I retired again. America's a pretty harsh place for crypto startups. They were successful, but we sold them to foreign companies because that's where they were going to thrive. And I started just focusing on angel investing. So I had decided to angel invest mostly in underrepresented founders, kind of focusing on creating more economic equity, Jedi investing really. And my co-founder in the fund, Jim Betcher, convinced me over the course of about 18 months that climate and investing in justice, equity, diversity, and inclusion aren't like a Venn diagram, but really a perfect circle. The climate justice is just justice. And that climate was a secular trend that would get more broad-based support if we invested well. And I kind of put up all these barriers to entry for him to convince me to start a fund with him. And to be clear, Jim Betcher is a pro-level VC. He's been investing as a venture capital investor since the 80s. He's on the Midas list. He's got a top 10 fund of all time. He's the real deal. And why this guy wants to start a fund with me is a mystery. But we've been friends for a while now. But he first said climate. I said, no, I don't know climate well enough. I don't know the climate markets well enough. Well, my wife is an environmental scientist, so she knocked me upside the head about that assumption. Then I said, no, I don't know the business of venture capital well enough. So then Jim said, I'm on the Midas list. I think I might be able to help you figure that part out. And so I finally got whittled down to saying yes. And I really got excited once I started meeting founders in the climate tech space. That's what really convinced me, because it feels as mission driven as the beginning of the internet did to me, where, originally all of those companies that we talked to in 95, 96, 97, they were all about democratizing access to information, and that was going to solve the world. That was a swing and a miss. We did not do that. But these founders are solving like real physical problems on the planet that we need solved rapidly and immediately. So, and they can do it. I'm actually more positive that we've got this thing licked, or that we can have this thing licked, because the science and technology is there. So the founders convinced me to finally say yes. And we put out the shingle earlier this year. We were about halfway through our raise. and we made some investments, and it's been fun.
Great. So what excites you right now?
Soccer. Maybe my kid just graduated from Turtle One swim level. But for work, what I just said, I think the most exciting thing that I've realized over the last 18 months really is that all of the problems that we're seeing in terms of climate have a solution that's viable today. This isn't like science fiction-y stuff. And we can fix issues up and down the climate stack too. It's not just renewable energy. It's not just decarbonization. It's creating a more circular economy. It's everything. And there seems to be like a consensus that it's the most important thing right now. I've never been more positive about climate change challenges, and that's what gets me excited. And then kind of the idea that we're going to rewrite the entirety of the economy with this. We're reindustrial. I really think we had like agrarian society, we industrialized, then we globalized in the 50s to the 80s, then we digitized from the 90s to now. And I think we're going to reindustrialize. And that's amazing. We're going to rewrite trillions of dollars of value chains on this planet. And we get to do it in a more conscious and thoughtful, intentional way. And I get to be a part of that. You know, I get to invest in companies that I think are going to do it the right way. So that's really awesome.
Great. So as you move into this new era of climate change, you see a lot of startups and you see a lot of investors there. What's your advice for people investing in startups and the climate sector? What do you tell them to do before they write that check?
Well, that's a great question. Don't be so negative on the first call. I find that venture capital folks in general, not everybody, but in general, are pretty harsh and pretty negative's the right word. They try to poke holes right from the first conversation. And I just don't understand that. As a founder, I don't understand that, right? Because by and large, the people that we talk to in this space are PhDs, big brains, smarter than me. They have solved some deep, hard problem through the use of exponential tech or some hard science. So the problem solution set that they've come up with is probably spot on. Maybe the product market fit's not there, but that's not for a couple of years down. We invest early, right? So I really want to see more positivity in the space. And that's kind of a VC thing versus a climate thing, I guess. I also think that these founders are doing the hard work and we aren't. This job is not as hard as being a founder of a startup. It just isn't. And I think go earlier is another thing I would see. Don't be so scared. Venture capital has gotten to be almost private equity level risk adverse. And I think we have to swing for the fences on climate in particular, but even I could say the same thing across the entire venture capital stack. And then stay collaborative. One thing that I am positive about in the venture capital community that focuses on climate stuff is that all the firms and managers that I know that I've been introduced to are very collaborative, much more so than in the regular VC world. Everyone wants to be on everyone else's cap table. Everyone's bringing deals to other firms and funds, and everyone seems to want like the whole industry to succeed. And that's because it has a mission-driven element to it. And that's not true with the sharp elbows in the software investing world. Not as true anyway. There's some firms that are like that. So, stay collaborative, because I think as we get some unicorns and decacorns in the climate space, sharp elbows might get grown. And I don't want to see that. I think it's important for us to stay collaborative.
And then on the other side of that equation, what's your advice for people running startups in the climate sector? What do you tell them to do before they go out to raise funding?
Oh, well, don't listen to people like me. No, that's not true. There are many great folks in this industry that I know that are really want to be helpful and can be very helpful. Maybe just don't pay attention if people are distracting, if they seem unexcited. There's a lot of folks that are overworked or they've made themselves overworked in my industry, and that distraction can lead to just lazy conversations, lazy interactions. And so I would say to any founder, not just climate tech founders, but specifically the climate tech founders, have the confidence and conviction that you're going to win. I think it's important as a founder, right? You've got to believe in yourself. But I think don't be overawed by people who are sitting in my chair. All we have that you don't is money, and maybe experience, and maybe some connections in the industrial. Jim's got these great. Asian connections in the major industrial space, and I've got connections with teams of people that we can recruit, and like we've got value to bring. But really, the people that are doing the hard work, that have solved something amazing, that are unique, are the founders, and have confidence that you're really the more important part of the value chain here.
Great. Well, let's talk about the state of investing in climate change. It sounds like you have a good group in the early stages of it, but how do you see the industry evolving from here?
I'll talk about, so I did a crash course in VC. I've been at the intersection of VC and startups for 25 years. So it's not like I didn't know the jargon, didn't know the scene, didn't know the players, but I really got to know I nerded out on portfolio modeling and kind of the full life cycle of a franchise of funds within a venture company. And I think, and the industry in general, which is kind of my thing, like I go meta and I can see the big picture. And the big picture for venture in general is that it's getting disrupted at every stage. I think the top of funnel in VC is getting disrupted by crowdfunding and non-dilutive capital, specifically in the climate space, super angels, professional micro funds, rolling funds, et cetera, et cetera, et cetera. Like all sorts of different ways to allocate capital, first check to seed to maybe Series A. Then at the bottom of the funnel, you're seeing exits and kind of the model of venture capital, portfolio models being disrupted by direct listings and SPACs, and I believe a lot of M&A will happen and a lot of mergers will happen in the climate tech space, because we're talking about like real physical solutions that have intrinsic value, not just software companies that are either going to go to mega or go to zero. And I think the squeeze is going to, in the VC industry, is going to happen in those middle rounds, Series A, Series B, Series C. Like, who's going to lead Series A? There's a great article that just came out. I forget where, but it basically said like, who's leading Series A? Everyone's going earlier and earlier and earlier. And Series A is like that inflection point where you have to learn how to scale. And that's really critical. And we can lead, by the way, Anthropocene can lead Series A, although we focus on pre-seed and seed, I'd say. But the middle round, C, B, C, like who's doing those anymore? Like that just feels to me like debt, private equity, other capital allocation is going to wipe that industry out. So I think that this is a good thing. I think that VCs being disrupted or having to innovate is important. And I think that the kind of personal relationship style model is going to have to come back, whereas it kind of started going away for quite some time. And so in the very best firms will have to either scale to gigantic size, and like the A16Zs and Sequoias and Tiger Globals, that's fine. They've got the brand, they've got momentum, they've just got so much capital, they'll be okay. Then firm with niche expertise, like the people that know that one thing in machine learning and can invest in it really well, and it's just a really tight community, they're going to be fine. I think of like NFX and their focus on network effects, for example, just one. And then, I think the ones that can just blow out valuations, like the Tiger Globals and the Vision funds, they just got a pile of cash. They're never going away. But I think that the very best funds that are going to survive that don't do any of those one particular things are going to be great editors. They're going to be able to actually have value add and real community surrounding them. That's a piece that's missing, I think, in the climate tech VC space. Is there aren't a lot of funds. Maybe there just haven't been funds around long enough to build up a strong community. Maybe Urban Us is a example of the opposite of that. I think they've done pretty well. I think they've got a pretty strong brand and community around them.
Great. And what do you think is the biggest change you'll see in, say, the next 12 months?
In my vertical, it's probably how collaborative everyone has been and will be. Everyone wants, like I said, everyone wants everyone in on all their deals and are very open and transparent. I think that what might change is that we get a little bit more data focused in our vertical. In the larger VC space, I think that you're going to see some superstar partners leave some superstar firms, because it used to be an infrastructure problem to do this on your own, to invest on your own, and it just isn't anymore. You can spin up SPVs easy. You can automate the entire process. And what firms used to give you was that. And I just don't think you need it anymore. So I think it's going to be more decentralized in a way, which is probably good.
Great. Well, let's talk about your investment thesis in climate sector. What exactly is it, and what's your criteria for funding a deal?
Sure. So, the elevator pitch is that Anthropocene Ventures is a deep tech and hard science climate fund. We fund founders and firms that leverage exponential technologies, things like blockchain and machine learning and artificial intelligence and quantum and IoT, advanced manufacturing, synthetic biology, things like that to have large impact on climate. I think kind of the thesis about why, the problem is obvious, right? There's a sense of urgency now surrounding climate change that there just hasn't been for the last 30 years. I think there's a ton of opportunity because science and technology have actually caught up to being able to solve these problems. I think that's new in the last 3 or 4 years. And then there's focus. Entrepreneurial talent and capital, both public and private capital, are focused on the problem. So sense of urgency, science and tech can finally do it. And everyone on the planet is wanting to work in this space. And so I think that there is a secular trend of public spending that's going to drive some valuations and some great exits. I think the amount of public capital that's going to come into the space in the next 30 years is probably going to be the largest growth market. So I think any reasonable, rational investor can make money in climate over the next 30 years. Where alpha is going to come from, where like really outsized returns and where real wins are going to come from, if probably today, if you're an early stage deep tech climate investor like me, focusing on niches that are going to be important in 5 years. Everyone's focused on the last 10 years, everyone's been focused on renewable energy and decarbonization technologies. Within that, subcategories of those are somewhat more interesting to me. But I think water is a big deal. Ocean health is a big deal. Space is under talked about. I think everyone kind of poo-poo space. Space investments are going huge, but because space is interesting, I think space and environment is almost the same thing. I think we're going to get the data layer that we need to figure out what to do well we're going to get from outer space. And also, commercializing space technologies for dual use on the planet is just going to make us consume less resources. So I think focusing a little bit more niche on the solutions that you're looking at is the way to go. I also think that like I said, I think we're going to rewrite every business process on the planet to be more green. And that means reindustrializing in a green way. And that's a lot of, I don't know a lot of venture capital investors that are, going to chemical plants or water reclamation plants or waste management facilities. And I've been all three. And that's really fun. It's interesting because I think venture is going to affect the 75% of the people that don't, live in the software world. And I come from a small town upstate New York called Troy, New York, a pretty industrial town that shrunk. My dad was a union organizer. I come from working class stock. And I think that venture is going to have more effect on working class people now than it ever has. And that's really interesting to me too.
That's great. Well, have you made any investments so far that you can talk about as portfolio companies?
We haven't announced any. There's a couple that I think there are a couple great companies that I could mention. Core is an interesting one. My co-founder, Jim, kind of found this technology group out in Montreal, helped them spin up a company surrounding a technology that produces biochar. Biochar is a great carbon sink, right? So I'm not so interested in direct air capture because that just seems like a very blunt force way to take carbon out of the atmosphere. And the business model surrounding that's a little challenging. But biochar is interesting. So Coragen takes agricultural waste, like almond shells, for instance, and produces biochar, which is a carbon sink. It's a natural fertilizer. It allows farmers to use 30% less water on their farm. The interesting part about Coragen is they also have a waste product called ferulic acid, which is very valuable. So they get software margins on their value stream, which is amazing in the space. And they have a proof of concept factory out in Modesto, I think, that is active today. So that's a really cool company because it's almost a circular economy play. It's not just climate related. There are 4 others that I can't mention today, but we've made some investments and we're looking to do another close by the end of the year, actually, because we've got a handful of portfolio companies we'd like to invest into.
Right. Well, with the climate change brings many new challenges for the startup and the investor. What do you find is the main challenge for the startup in the climate change space? What do you see they have to struggle with more so than the software or the other ones you've dealt with?
I think that there's the volume of VCs that understand the science and the technology is low. There's just not a lot of PhDs in chemistry that are also VCs. So I think that the ability for the venture capital community to take the pipeline of deals and diligence them in a way that makes sense is challenging. But I also think that just highlights the fact that VCs think they need to know everything. And like sometimes, yeah, of course you have to validate the science, but then you also have to know the markets that science and the solution that science begets is going to be put into. And it's like every VC in the valley is a software guy, and so not a lot of people understand the water market in Southern California in the VC world. And so the expertise, really, there's the lack of expertise in the VC industry. It just means it's going to be slow going at first. I also think that probably the other side to that is that founders in this space are usually scientists, or they're very highly technical, and they might not know the markets that they have to sell into. And so, you get expertise mismatches all around. And I think people have to be braver about saying, I don't understand that, and then going and learning it. And that's harder work than, what's your CAC? And I've seen 5 deals like this, but you're just applying it to a different market in the software world. For a while there, it was, we're the Airbnb of Postmates of Uber. And it was all the same business model. You're either selling data or cutting out the physical middleman and creating a digital one. Those are the 2 business models of the last 20 years, and everybody understood them. These are business models that are like, you're selling sensors into water facilities around the world. Like, that's a different beast, and for everybody. And I think that we all have to get pretty comfortable with that.
Right. And then what do you see as the primary challenge investors face in this space that they didn't in the other ones like software?
Yeah, the same thing, understanding the science and the tech. Okay. Crucially, really understanding what I call the insertion point for the product or service. And I mean, you have to have software VCs that get consumer or enterprise, but you don't have a bunch of VCs that really understand, like I said, chemical manufacturing markets or automotive or supply chain logistics or concrete. And we have these industries that were all industrialized, and they were really optimized over like 200 or 300 years, and they're on autopilot. And so they're resistant to innovation too. And VCs have never looked into that. VCs don't interface with that. And that's going to be hard. That's the cultural shift that has to happen. Luckily, I do think that everyone understands that it has to happen. For the last 10 years, I think there was a lot of resistance to even that it did. And I don't think that's a problem anymore.
Great. Well, you mentioned several key sectors here already: water, ocean health, and space technologies. If you had to pick one that you think is the best opportunity for investors to pursue, what would you put at the top of the list?
Oh, that's a tough question. I won't give you one. I can't answer that question. I think water is undervalued. It got more hot in the last 6 months, but I think it's still undervalued. Turns out we all need water to live. Ocean health has an outsized impact on climate in general. So, and kind of creating business models that allow companies that are dealing with ocean health issues, that's hard. Like, everybody can agree we want plastic waste out of the ocean, but what's the business model that makes that like a viable venture investment? That's a question mark. I think that's a big problem in the space too. There's a lot of things that we do need to do, but how do you make money on it is a challenge. I think the one that doesn't get talked about enough now, and I think will become more important, is probably like land use and biodiversity. Again, like, how do you economically value that stuff? There are ways to do it, but it's a little esoteric and not a lot of people talk about it. And I think that biodiversity, the loss of biodiversity over the last 10 years has had a negative economic impact on the planet, and kind of quantifying that is really important, and making sure that we see that it's almost like the invisible negative drag on the economy is much harder to show than, or get people to rally around than, hey, we could add this $3 trillion to our GDP because we're investing in da 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 da. So I think that's I think if I were going to say who's the sleeper in the space, I think biodiversity is.
That's interesting. Great. Well, good to know. So in the last few minutes that we have here, what else should we cover that we haven't?
Maybe the LP landscape. LPs are generally like a pretty opaque lot, but new managers need money. And by the way, new emerging managers, first-time funds generally outperform because they work harder. Probably, I don't know why, but these are new companies and new markets and new verticals and changing businesses that have never been disrupted by this. So this whole thing requires new thinking, and investing in the same old funds isn't going to cut it. So I think that there's some really good people working on making the LP landscape less hard to interface with. And I think, that's the thing that we should probably talk more about in the industry.
Great. So how best for listeners to get back in touch with you?
My inbox is open. So Matt at anthro.ventures is probably the best. I'm at MJM11 on Twitter, and I'm trying to be part of that Twitter thing these days. So those are probably the two best ways.
Great. We'll include those in the show notes. Want to thank you for joining us today and hope to have you back for a follow-up soon.
Would love to. Thanks a ton.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.